Hmm. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is June the 26th. I'm delighted today to be joined by two of our regular commentators, Maliha Bengali, founder of MB Commodity Corner, and Jose Shalhoub, who is LATAM consultant at V Energy Global. And delighted to have joining us today Dr. Jeff Brown, president of FG Energy, also based here in the Emirates where I am. So great to have you all with us. Thanks for joining us this morning. Maliha, let me start with you. We've got a couple of news bulletin headlines on our list today. One is, let's start with the macro story perhaps today. The Fed, again, sort of nothing new, but I suppose expressing more sort of reservation about whether it's going to, cut rates at all this year, and even more confidence that we could indeed see an increase if this inflation doesn't come under control. Give us your take mid-year now, what we should really be expecting to see in the next quarter or two from the US Central Bank.
Thank you, Diana, for having us on. That's a very good question. There has been some talk about a potential interest rate increase, but that's not being priced in by the market. No one is expecting that. Now, the data is saying that the Fed's going to possibly cut once, if not twice, starting September or later this year, possibly after the US elections. If you look at just the data, though there is no call for a cut, right? Because data is actually slowing down and softening, sort of rolling over. We were still having a pretty good employment market, 4% unemployment rate. Jobless claims are picking up, but they're not in danger yet. US economic growth is robust, softening. So there is no reason for the Fed to cut. Having said that, the reason why they should cut is because the market has a two-tier economy. The real consumer is tapped out. The banking system is in stress. So the Fed is in perplex right now, because if they cut rates too soon, which the market is screaming for, the inflation might go back above 3.5%, because inflation has not come back to the 2% number. The whole equity market and every single asset class is waiting for the Fed to cut. And I think that's the big dilemma right now. The window is very narrow. And if they cut right now, it'll be too preemptive. So they're going to go steady as she goes and see the data. The markets are holding up. They're going to wait probably to see if things go back down. And inflation is sustainably below 2% to do so. So we think that they probably won't cut till much later. The question is, does the market need it? Yes, the real economy probably needs a cut, because US interest rate is pretty high in terms of the interest expense bill, the budget deficit, the consumer being tapped on the mortgage market. So there really is a two-tier economy right now where only the tech stocks are doing well. But from a macro point of view, no, the dollar's going to go steady as she goes right now. And there's issues with the other banks, right? Bank of Canada, Bank of Japan, the Euro, they've all cut. So we spoke about this last month, they're outdoing the Fed for right now. And that's why the dollar is staying strong. So that's pretty much of a headwind for global macro markets as the dollar stays higher for longer.
Okay, thanks very much for that, Maliha. Dr. Jeff, welcome again, and thanks for joining us. Well, let's talk a bit about that macro policy, but how it impacts thinking and sentiment on oil markets, because that should obviously be slightly bearish if we're looking at, steady interest rates and not being eased, impacting demand, impacting economic sentiment. What's your take on that? What's your outlook for the third and fourth quarter for oil demand? Anything different from what we've seen so far or expected this year?
Yeah, thanks for having me on. Obviously, this can create headwinds if it means, strong dollars can have headwinds for oil. The one thing, though, is we see demand pretty strong third and fourth quarter. We have a growing 1.6 million barrels a day, third quarter, 2 million barrels a day. This is year on year in the fourth quarter. So it all looks pretty good. And have put in, we've always projected for some time now that there'd be strong draws in this third quarter. And it does seem like we're moving in that direction, right? We've seen this recent move in price, and there's a lot of debate why it's moved so fast, so quickly. But at least in the background, we think there's supportive elements where we'll start to see stock draws ahead. So, from our point of view, crude flat price anyway, we're looking at things moving up, possibly even pushing over 90 over the next couple of months. It'll be more challenging in 2025. Okay. That's when balances look a lot longer, and OPEC will have to make calls, but that's a sort of a separate issue. In the near term, we're constructive for price.
Okay, great. Thank you. Thanks, Dr. I was going to ask you my next question was going to do you think we'd see above 90 even this year, let alone the next quarter? But you seem to be confident we're going to see that at least short term, and we'll come back to you on that. Jose, great to see you again. Since we last spoke to you, there's been a couple of developments. We've had the, in LATAM at least, we've had the Mexican elections results come out. But I want to focus before on that, on a headline again on our news bulletin today, which is about Venezuela's crude, using the dark fleet supposedly to take crude to Cuba. I mean, is this just due to a lack of vessels? Is this something new? How does that, what does that tell us about what to expect going forward?
Thank you very much. Yeah, well, this is not something new. I mean, Venezuela has been using dark fleet, especially to supply oil to China and to Asian markets via ship-to-ship, transfers, especially from regarding oil exports to Malaysia and from Malaysia to China. Using dark fleets and shutting off transponders of ships, especially when sanctions, by the US were harder. But after the Biden administration softened the sanctions against the Venezuelan oil, that situation changed a bit. Right now, still the Biden administration has the sanctions a little bit softer, waiting to see what will happen after the Venezuelan elections next July 28th here in Venezuela, presidential elections.
Have we seen, sorry, Jose, just to on that point. So are we still seeing the Chevron activity going on undeterred, and other possible sort of interest in the sector until at least July the 28th, that the US has sort of opened that soft window for things to carry on as normal since April?
Yes, absolutely. Well, first of all, most of the recovery of the Venezuelan oil production is due to the Chevron activity ever since the sanctions were lifted by the Biden administration at the end of last year. And second of all, special licenses have been given to kind of a few U.S. and European oil companies after the recent decision by the OFAC to wind down operations from for different companies that were still carrying out operations here in Venezuela, waiting to see what will happen after the elections, because the U.S. government has not been seeing any hint that the Venezuelan government will carry out competitive and fair elections here in Venezuela so far. We'll see what happens after the July 28th. Okay,
thanks, Jose. It is definitely election season, isn't it? I mean, we had the EU elections, we've got the UK elections. That's the next big one. We just had India, which was quite sort of dramatic, if you like, and of course the big one in November. So it's certainly on everyone's minds. Maliha, back to you. I mean, Dr. Jeff was just saying he's quite confident about the fundamental support for the market, but we've also seen the hedge funds, the money funds sort of coming back, having shorted a lot earlier in the year, and now the feeling is they're all, believing that we're on the way up. So how much is that playing into? Do you think that's really what's pushing prices, and perhaps not fundamentals, as Dr. Jeff has said?
So that's the biggest debate in the market right now. OPEC itself assumes a 2.2 million barrels per day demand pickup from this year. We are not seeing anywhere close to that. Now, the entire market, every equity sell-side analyst and commodity analyst expecting a demand rebound in second half in Q4. That goes with the economy, that goes with the global economy and the oil market. Now, if you look at our cross-asset models and exactly what we're seeing from a macro point of view, we don't see demand. We track demand daily, every day. If you expect a magical Q4 recovery, it's still a bit of leap of faith for us. Yes, if the demand picks up from China, which has been very weak, and other parts of the world, then sure, but we're not seeing that demand pick up. And we're actually seeing US going to a bit of a recession here. So we are, pretty much offsides here. But the reason why oil price is staying so low is because OPEC has kept the market tight. Yes, they're going to release barrels in Q3 and Q4, but that's only if China's demand picks up. So if it doesn't, what does that mean for the price, right? So that's the debate right now. Are we in a recession? Are we in a magical no landing recovery? Which I'm not really sure is going to happen. So it's open right now. If the US starts cutting rates and they do another fiscal spending surge, anything can happen. But as of right now, demand is supportive, but there's a bit of leap of faith for the Q4 this year. And that's the reason why most hedge funds are bearish on the macro side. Look at copper, look at aluminum, look at iron ore, right? That tells you commodity markets never lie. That's been her mantra all along.
Okay, thanks, Maliha. Dr. Jeff, let's talk a bit about demand forecasts. I mean, you were quite positive about the immediate, but China, I mean, one of your previous hats was the IEA, and of course, this year we've seen divergent forecasts on demand between the IEA, between OPEC. We still seem to see that divergence, and OPEC Plus has not adjusted its demand forecast despite the fact that we're halfway through the year. What do you make of those differences, if you like? And I mean, you gave us what your expectation is for demand growth, but how much is China playing into that? And how, you know, does the market really pay much attention to those forecasts, or are we just taking it step by step as OPEC does in its policy?
Oh, it's all good points. I mean, to be honest with you, I don't really know what OPEC is doing now with this forecast because it looks way too high to us. I mean, they seem to just be sort of rolling it over, and frankly, maybe hoping that demand will come up to meet their outlook. Certainly, if you look at the first part of the year, it doesn't look like a plausible number. So our number is more in between sort of the IEA and OPEC. IEA seems to want to be on the other side, a bit too bearish. I would say, I mean, realistically, it's the second half of this year where we see this strength. Some of that's seasonal in terms of demand.
Yeah.
I would agree, though, that in the fourth quarter things can get interesting because the question is, how forward-looking will the market be? Will it start to price in ahead some of that sort of seasonal demand weakness that we'll see in the first part of 2025? So it will be, I think it'll be reasonably clear selling for OPEC over the next couple months, but then it'll get challenging at the end of this year.
Okay. And I mean, what about non-OPEC oil? Just to stick with you, Dr. Jeff, on that, because the second half of last year, and as we got towards the end of last year, incremental US production, surprising some in the market, supposedly. Is that possibly going to throw a spanner into the works of OPEC's plans?
Yeah, I mean, based on our numbers, and we look at this bottom up, we have a bit of a pause in non-OPEC supply growth. That's certainly been an issue, as you point out, through the second half of the year. That's the pause. That's part of the reason that we're supportive of price. But then it's a problem again in the first half of 2025. So if some of that gets pulled forward, you're right, it could be a risk. We don't see it, but that's really why we see the risk. It will come back to haunt us in the first part of 25.
Okay, thanks, Dr. Jeff. Jose, back to Latin America. Let's talk a bit about Mexico. We had the election results there. Any change? I mean, before we had the results, remember you telling us that depending on which of the candidates won, that would be a nuanced change in energy policy. Now that we're there, what are you seeing? Any promises made? Any indications made on energy transition versus conventionals, etc.? What path do you think that's going to take? And how is that impacting other countries' energy policy, perhaps in the region?
Yeah, sure. The challenges for the Mexican oil industry are very, very daunting, very high because of the damages done by the past administration, and the Mexican oil industry has been suffering from different problems in the past decade or so, especially regarding Pemex. Pemex has been suffering from corruption, different accidents and explosions in different facilities offshore during the past administration of López Obrador, and even before. Nobody exactly knows what the current administration of the recent elected President Claudia Sheinbaum will do, but definitely we have seen how the production of Mexico has been dropping dramatically to roughly 1.2, 1.3 million barrels per day. China will be one of the most interested in terms of seeing how the Mexican oil production recovers or not, how the recent elected government carries out different changes because Mexico is suffering real problem regarding production and investments, and how it carries out a fight against corruption inside Pemex, But
is that discouraging new investment at all, new external foreign investment?
One of the elements, because Pemex historically has been suffering from from a deep, case of corruption. The past administrations, not only of López Obrador, but also Peña Nieto, have been unable to kind of clean off corruption inside the Pemex industry, but definitely that'll be one of the biggest challenges in fighting off corruption in Pemex and Mexico's oil industry.
Okay, thanks, Jose.
Thanks.
Maliha, let's talk a bit about, I mean, we mentioned OPEC and non-OPEC, but let's talk about Russia, because we have another headline today that its oil and gas revenues are up 50%, okay, just for the month of June, but they're still looking more positive this year than last year in general for the year on year, up 21% apparently from 2023 so far. So, again, I mean, the sanctions not biting revenue as much as, the Western powers that be may want them to. The oil is flowing, which is what they want, but Russia seems to be doing okay from a revenue point of view. Are these shipping sanctions not biting at all? We had somebody on earlier this week who said, no, they are going to start to impact Russian shipping and therefore getting it to market. I mean, what's the latest?
You're right. You're absolutely right. I mean, if you look at the data from last year to this year, most of that Russian oil has going towards India and China. We know that, right? So there's been a massive supply chain shift where, China needs about 10 million barrels per day of oil and Russia supplies that. So the world's largest consumer, the world's largest supplier on cohorts, which is all right. I'm not saying China is going to be using only Russian oil, but they've got a great source. And, India has no qualms about getting cheaper oil. The shipping sanctions, to be honest with you, yes, they do make an extent, but there's so many workarounds. I mean, we know a lot of the players in the middle, a lot of shipping brokers out in the Middle East right now. Some of them are actually circumventing the sanctions. There's a lot of trickery going on. In our opinion, it's been very simple. These sanctions are all about optics. If it anything at all, the world has pretty much shifted. The alliances are shifting. The trade ship routes are shifting. Shipping rates are higher. So once again, going back to the consumer and inflation, these are going to go into a higher cost of production, right? Higher cost of inflation, which makes the Fed's cut a lot harder to call for. So yes, we don't see a shortage of any oil. I mean, let's go back to the basics. OPEC has kept about 6 million barrels per day off the market for the last 2 years. If those barrels were released to the market, oil would be trading between 60 and 65. So let's call a spade a spade. So no, we do not see that issue right now. And if you look at China's data, which is very interesting, China has been taking a lot of oil right now and putting into inventory. They've been storing oil. So their real demand actually has been a lot weaker. And no one's been talking about that. So where do we see this demand pick up in second half that people talk about? But no, sanctions are not playing an effect right now on oil supply.
Maybe
Thanks,
I could add.
Yeah.
I
Yes?
just could add one thing. I mean, we were just traveling in China and India, speaking with our clients there, and they were all complaining that the discounts that they were getting last year at this time have all shrunk. It's all gone, and they were wondering when they're going to come back. They're hoping that things are going to come back, and I think obviously that's probably large part of the reason they've been getting more revenue. That those $20 discounts that we saw at the peak, 20 plus for Russian, are just pretty much gone.
It's true.
Yeah. But is that, Jeff, then impacting, I mean, obviously it's impacting appetite somehow between China and India, but they're still taking that Russian oil, aren't they? Because it's still preferable to the other.
Yeah, you take it. It's just that rather than getting a $20 discount, you get a few dollars, $3 or $4, which obviously they'd like to get more, but it's still attractive, and it has to price to be attractive. Certainly in China, they'll be comparing, as an example, one client we're speaking to they look at Iranian Light versus ESPO, and those are the two crudes they're comparing in terms of pricing. So there's sanctioned barrels are just competing each other in these markets, and they're getting better at getting to market. So that's the reality right now.
Well, you mentioned Iranian barrels. I wanted to ask you about that. I mean, last year, Iran had a pretty relatively good run with its exports, with the US sort of allowing things to leave Iran and mostly to China, as you mentioned, and the US has relatively little control there. But I mean, what's the picture this year? Have things been steady as she goes, as far as we know? And what should we expect in the second half of the year of from the Iranian oil sector? I mean, particularly in light of the fact that we're going towards a US election, will that have any impact at all from a policy?
I mean, Iran's getting pretty much everything it wants to into the market, right? It's at discounts that it may or may not like, and it's occasionally pushed back on these discounts, but it's getting most of the crude and products it wants into the market, maybe a couple 100,000 barrels a day more if it didn't have sanctions. In terms of, we don't see that changing under Biden. I mean, the Biden administration is pretty clear that they just want to create friction in the market, right? They want to create these discounts, but they want the oil to get in. Trump is more complicated. I hear a lot of people will be saying now if Trump came in and put sanctions back on, then Iran would still be able to get the oil in the market because they've come up with all these workarounds. Frankly, I'm not so convinced on that because he's such a wild card. You know, he makes people nervous. Even in Iran, he makes people nervous. So I think he could have an impact if he were to come in. I probably wouldn't focus on that until early 2025. And also realistically, he wouldn't do that unless he had some kind of cooperation from others in the Middle East to replace those lost barrels. So really, it's a Trump-Biden issue, I would say, more 25.
Okay, interesting. And you know, we're all going to be watching the debate this week, I hope, to see how we can guess which direction that's going to go in. There's our question for today, which is what will break oil into the, securely into the 85 to 90 range. It's blipped above 85, but, will we kind of go into that range now in the third quarter and perhaps even beyond? Will it be the funds going long, or more funds putting those positions, and confidence in the market stronger than anticipated demand, surprise demand, maybe from China, or OPEC plus caution on its planned cuts policy, i.e., what it's planning to reverse on the cuts, and we know it's going to be monitoring the market step by step. So let's get people's response on that. Which of those three is going to be, most influential to help oil break into that range, if it does at all? Maliha, let's go back to you. You talked about the US dollar, it's steady as she goes, obviously being influenced by interest rate policy, but we have a lot of people on the show who are very convinced that it's, medium term, the end of the dollar's days, right? And you've got other things taking over, other alternatives slowly but surely. Is that, and then you've got, as you mentioned, that interest rates were going to have to come down because of the US debt problem, and that's obviously going to impact the dollar. But, what are the timeline for that, do you think? Are we looking, if you had to guess, would you say we have another few years where really things are going to remain the same, or could it be more dramatic than that?
You're absolutely right. The wheels of change are in motion, but it will not happen overnight. I love how people talk about the petrodollar, and I've been writing about that as well. But let's just face it right now, there is no alternative currency to the dollar right now. We can have, China and Russia and India trading currencies in small quantities away from the dollar, and that's fine. The world's shifting, but will it happen overnight? Of course not. The dollar is still the most valued currency in the world. In the long term, yes, we're seeing a plateauing. It's going to get less and less important, but we can't call the end of the US hegemony anytime in the near future. I think that's like a debate for much longer term. Obviously, people are thinking about it. The other thing is liquidity. What can we possibly have to replace the dollar? The ruble, the yuan, the euro, maybe a basket of currencies. Even talk about Bitcoin or some of the digital currencies, right? But this is much forward thinking. Just going back to your question on the survey, this is really interesting. So people always talk about demand, but manufacturing is the part of the market that if demand picks up, yes, we can see a demand recovery, but manufacturing is still below PMI of 50 across the board, and that's not picking up. We have a rolling goods recession, and that's the part of the market that people don't understand, that we're not seeing a pickup. So where do the demand numbers come in? So, forgetting the fact that OPEC will play games on planned production cuts, I think demand is the key thing here, and a lot of people are expecting that to pick up rather than stay low for longer. We should look into that.
Yeah, and of course that's causing, the disparity between gas oil and gasoline, and obviously which is usually the case in the third quarter. Gasoline takes a blip, but the manufacturing side, particularly in Europe, hasn't recovered fully. Jeff, I just wanted to go back to you just briefly, also just to talk about while we were on the question of Russia and shipping and sanctions, Iran. We went to Iran, but we had somebody on the show saying that, the news of stricter sanctions by the EU on shipping, particularly in the Baltic area, maybe in the Danish Straits, that if those sanctions on dark fleet, if you like, become not, sort of stricter, then that will actually start to impact Russian volumes on the water. Whereas so far we've sort of still seen them float, right, and get to that. Would you agree with that we could start to see some impact there?
To be honest with you, we've seen this talked about so many times that I have to put on a skeptical eye that everyone's finding workarounds, right? And ultimately, if both the US and EU want to get the oil out, I don't know why it would have an impact. We just have to remember in the background, they want the oil to get on the water. So, but they wanted to get on at a discount. So I don't I'm puzzled why people keep coming back to this and saying it's going to have a large impact. It's going to have a large impact when the players that are designing it want the oil to get on to move.
Okay, thanks, Jeff. Jose, back to South America. We talked about Mexico and Venezuela. Just give us your take on Brazil and Guyana, which are the slightly more positive stories, aren't they, at the moment in terms of increased production, in terms of impacting even global supply. Have there any expectations there for the second half of the year? Anything new that you can tell us in terms of volumes that are expected that may impact, obviously, non-OPEC supply?
Yeah, well, Guyana is the brightest spot in South America right now. Let's see what the current government of finally will do regarding new investments. Also, there's the ongoing crisis over the Essequibo with Venezuela as well. Nobody knows exactly what will happen with that, but definitely that will have a kind of impact on the current government of Guyana and how it will carry out new investments in offshore in Guyana. According to different projections and outlooks, the Guyana production will definitely top the 1 million barrels per day in the next couple of months. Definitely that's the brightest spots in South America, and it has drawn definitely the attention of OPEC and the recent reports and the monthly reports. Also Brazil never fails, never disappoints. President Lula has been rather smart in keeping Petrobras happy. The production has been going steady. Despite the fears that a new administration of Lula could doing some harm to Brazil's oil production and Petrobras, but Lula has been pretty much smart. He's always been in trying to keep Brazil's oil production flowing and steady. So definitely Brazil and Guyana, and also Venezuela. Don't discard Venezuela because, of course, we'll see what happens after the elections. But the recovery of Venezuela has been slightly, but definitely steady. We might top the 1 million barrels per day in the next couple of months as well. So definitely those are the three brightest spots. And don't forget Argentina as well. Argentina with the President Milei, the shale oil in Argentina. Let's see what the current Milei administration will carry out in terms of new investments. So definitely those are the four bets in South America for me in the next couple of months.
And just think what they could do if the corruption could be eliminated and all that investment would flow in, then OPEC would have a real problem. There's the result of our question. So stronger than anticipated demand is the one that could push things more comfortably into that range. And of course, that's the question mark. Jeff, I just wanted to go back to you to talk a bit about LNG, because I know that's one of your areas of focus. And you mentioned Trump, Biden, and of course we saw sort of, I suppose, the election move by Biden earlier this year about, freezing new LNG production. We have a headline today which talks about also the costs of LNG production, how that might also sort of stymie operations in the US. What's your view for US LNG going forward, and also just short-term nat gas prices? We've seen a bit of a recovery, but everything's looking quite muted, isn't it there?
Yeah, I mean, this has been an issue for some time, actually, with the inflation we've been seeing. The U.S. contracts were all signed sort of bottom of the barrel prices, right? They were very, very, very competitive. We're talking right around $2 per million BTU to liquefy the LNG. And costs have gone up, right? So we saw the big news was on Golden Pass, which is this Exxon and Qatari project, where basically one of the main contractor went bankrupt. So we hear about this all the time in the background. We hear about people trying to maybe rejig contracts slightly to raise prices, but that's obviously hard to do. So I think this is just something brewing in the background. A lot of this is under construction. I don't think it will materially impact the supply, but that plus the Biden pause can make this big wave that is coming in 26, 27. It can sort of make it, delay it a bit and make it less of a huge wave, more of a moderate wave.
Okay, Maliha, thanks, Jeff. Last word to you. Just let's talk about Europe. and because you're based in the UK and so closer to that zone. Again, from a sort of gas demand, summer demand coming up, obviously you've got usually more so in this region for AC, but I mean, gas demand does surge in Europe for different sort of industrial purposes as well. What's the sentiment there? We've seen, good storage still ahead of, next winter. So any sentiment there on the markets for gas going forward into Q3, Q4?
I think you're absolutely right. Storage is pretty full right now, about 70%. If I remember, I checked it last time. The last few months have seen a bit of a pull into Asian LNG. So obviously that took prices high into Asia. China's been very price sensitive. So we've seen demand go there. But as prices have gone higher, they're going to let go for a few cargoes coming back to Europe. But there is no shortage of gas as well, right? We were at a point 2 months ago where we thought storage would be completely overfull, right? So right now, I think gas prices have rallied up right now, but we don't see a bit of an issue. I think winter 24-25 is still out. It all depends on Asia, Japan, China demand, but near term in a bit of a tight range in terms of some coal to gas switching, given gas prices got really cheap, and then now we're coming to a point where gas is flowing back in. So no, in terms of the demand pickup, like we said, the main thing is the European economy. We talk about a technical recession in Europe right now. The recovery in the first half is fizzling out yet again. ISM's PMIs are lower. Consumer demand is weak, and we've seen the PMIs again go back down. So we don't see a massive demand pickup from Europe, and supply is still very comfortable from a gas perspective.
Okay, thanks so much, Maliha. Well, I'm afraid we run out of time for today. We didn't get onto geopolitics. I did want to discuss a bit the premium there and whether that's creeping back in. But there's also a halftime talk interview that we're going to be playing in an hour UAE time with Ravi Batiani, all about European tankage storage and how the different sort of dynamics, if you like, the flow dynamics globally may be impacting that, and also the trends in refining in Europe and offshoring of that. So very worthwhile listening into that interview. But thanks so much this morning for joining us, Dr. Jeff Brown, Maliha Bengali, and Jose Shalhoub, and have a good weekend almost there ahead. Thanks so much.
Thank you.
All the best.
Bye now.